Which of the following adjusting entries is needed to record the bad debt expense for the year? There are three different methods for recording bad debts. One is the direct write-off method. Direct write-off method is when we identify a specific account to be uncollectible, then we write it off. Okay. The IRS, that's the one the IRS wants us to use. There's also two other methods. There is the allowance method, or there are two allowance methods. And the allowance methods, one is based on just a percentage of sales based on our experience. We say, well, we have sales of X, and we've experienced that over the years 3% of our sales on account are uncollectible, and so we just take this percentage, and we would do that every month that we have a sale. The other method, which is more precise and accurate, is the analysis method. We look at our accounts receivable, we look at how old they are, and knowing that the older an accounts receivable is, the less likely that we will collect it. Someone who has a receivable that is current within 30 days, we have a high probability they will pay. But once a receivable is 3 months old, well, there's something wrong here because they were supposed to have already paid it. And then it gets 6 months and so on. And so it becomes less likely that we will collect that money. So we then do that analysis, and it's much more precise. In this case, it says the allowance for doubtful accounts has a debit balance of $1,200 at the end of the year before adjustment. The company prepares an analysis of customers' accounts and estimates the amount uncollectible accounts is $13,900. So they've done the analysis method, which is the more accurate of the two methods. The analysis method, we take in half to adjust on that balance. We look at it, and we look at the receivables. We see how old they are. Based on our experience, we know that one that is 90 days old is less likely to be collected, and we have a percentage. Those that are 120 days old, those are even more unlikely to be collected, and so we apply those percentages. We then add all that up to come up with a dollar amount. In this case, they're saying, I'm going to draw a T account here for us, and the allowance for doubtful accounts, which is a contra asset account. Okay, the accounts receivable is an asset account. The allowance for doubtful accounts is a contra asset. It contradicts norm, so it has a normal credit balance. In this case, it says it has a debit balance of $1,200. So that's the current balance of it. We want it to have, based on our analysis, a ending balance of $13,900, and that would be a credit balance. So we need to figure out how much do we need to credit the account for. Well, we need to credit enough to create a $13,900 credit balance. It has a debit balance of $1,200, so we have to offset that also. So the total credit then is going to be $1,200 plus $13,900. So the dollar amount is going to have to be $15,100. We are going to debit the bad debt expense for $15,100. We'll credit the allowance for doubtful accounts for $15,100.